My name is Fisobuhle Mbuto, and today I'll be taking you through some of the highlights from our Lululemon report. So just on the summary side of things, we have a buy recommendation with an intrinsic value of $544, and when the report was released, the upside there was about 70%. This is primarily based on Lululemon's stronger margins relative to peers, as well as compelling returns when you look at it from the perspective of the ROEs and the ROAs. They also have low global penetration relative to peers, and they have a long-term growth primarily embedded in their global expansion. Just to contextualize it a little bit, their North America to non-North America revenue is split between 79 and about 21%. In FY26, they expect that international business to contribute closer to 31%, and then over the long term, about 50%. So what this does is it gives us a good runway for potential growth within Lululemon itself, even excluding their goal to increase exposure into their menswear, since their products are primarily focused on women's wear, as well as just new product innovation overall. They are also trading at high discounts relative to their own history, and also when compared to the S&P 500. And there have been a couple of events over the last 18 months or so that have negatively impacted the price. One of them being change in the global creative director, a change in chief product officer as well. And then earlier on in the year, they came up with results, and the full year guidance was a little bit less than what consensus expected. For revenue, management guided growth for FY24 between 11 and 12%. Consensus expected 14, and they did take a little bit of a kicking there. But when you contextualize all of those points, they haven't changed the value proposition of Lululemon overall. And I think given the current trading discounts and where the share price is at this moment, it does provide us with a good entry opportunity into a quality company. They also do have a strong balance sheet, which they'll definitely need given the amount of capital they'll need to expand globally. The cash balances are typically more than enough to cover the capital expenditure needs, so it does protect on the execution risk side of things when it comes to the global expansion, as well as they have a good amount of control over the customer experience because their wholesale revenue is about 9%. To compare, Nike's wholesale revenue is closer to about 56%. Online revenue for Lulu is about 45%. For Nike, it's a little bit less than half of that. And then company-operated store revenue is at about 46%. So this speaks to about 91% where Lululemon is involved in the end customer's experience, and it is seen through the returns as well as their margins as well. So that overall does contribute to our buy recommendation. But in terms of things that will change our mind, the first is just a strategy pivot to no longer expand globally before they reach that long-term 50-50 goal. Our primary base case here is that we expect that a lot of the growth within Lululemon itself is baked into their global expansion. We think that a strategy pivot away from that would materially impact our view on the company as a whole, and also a consistent deterioration in their margins, their earnings, and their balance sheets. The margins and earnings particularly being ones where they are a little bit apart when compared to their peers, and then the balance sheet strength speaking a little bit more to the execution risk of this global expansion, given the amount of cash they would need to expand on it.